Hey everyone, welcome back. December gave us another wild week. Today we are hitting the Fed move, the jump in yields, and the tug of war inside stocks. So let's start with the Fed. On December 10, it cut rates by a quarter point to a 3.5% to 3.75% range, and the decision split policymakers three ways. Two officials wanted to wait because inflation is still above target and fresh government data has been scarce, while one pushed for a bigger half-point cut. At the same time, the Fed confirmed it had ended balance sheet runoff on December 1 and rolled out reserve management buying, starting with about $40 billion of short-term treasury purchases in the first month. They also removed the cap on standing repo operations, basically strengthening the money market backstop. The vibe was supportive, but not carefree. Cuts are happening, yet the bar for more easing just got higher. And that uneasy mix is why traders spent the rest of the week rotating, not celebrating. Stocks ended the week with a split personality. The Dow rose about 1% and even hit a record, while the tech-heavy Nasdaq fell about 1.6%. Big AI-linked tech shares slid as investors worried that the data center spending boom may come with thinner margins and slower payoffs. But here is the key point. Money did not leave the market, it rotated. That is why the S&P 500 slipped only about 0.6% for the week, even as the most crowded theme got shaken. Bond yields pushed higher again, with the 10-year Treasury climbing to around 4.18% by Friday. That matters because higher long-term yields hit the present value of future earnings, which is exactly what high-growth stocks live on. So what does this mean for us, even with rate cuts? The market can still feel tighter if the long end refuses to cooperate. Expect more tug of war between stocks and bonds whenever yields move first. Investors also had to trade through a data fog because a long federal shutdown delayed key economic releases into later dates. With major jobs and inflation reports pushed back, the Fed and markets leaned more on partial signals and positioning. Now, here is what matters. Uncertainty itself became a driver, feeding short, sharp moves on headlines. If the data fire hose returns all at once, the next stretch could feel even noisier. Across the Atlantic, UK growth disappointed, with GDP down 0.1% in October and the three-month measure also down 0.1%. That kept traders pricing a high chance of a rate cut at the Bank of England meeting on December 18. But here's the key point. Slower growth abroad adds to the global easing story, even while inflation worries linger. It is another reason this week felt cautious, not euphoric. Now zooming in on the SPY, the SPDR S&P 500 ETF, and this is where the mood quietly shifted this week. Price broke below the rising trend channel and is trading about 0.8% under the lower boundary, and every bounce back into that band has been rejected. That lower band is now acting as resistance, which tells you attempts to reclaim the uptrend are still failing. This ties back to the cautious tone after the rate cut, because even supportive policy did not stop sellers from leaning on rallies. So what really stands out here is structure. This has been a strong channel with most sessions inside it, yet we just slipped out with rising volume pressing into the boundary. Daily range is still tight compared to the channel width, which means a real recovery or a deeper break likely needs a bigger volatility push. That leaves the market balanced on a knife edge, calm on the surface but clearly under pressure. At the same time, we flip over to the QQQ, the Invesco Nasdaq 100 ETF, and the pressure is even more obvious here. Price broke cleanly below its rising trend channel and is sitting roughly 2% under the lower boundary, with that band now acting as firm resistance. This answers the question from the SPY chart, because tech is where the damage concentrated after the Fed cut, especially as investors rotated away from crowded AI trades during the week. Volume has been rising as price leans into that lower boundary, and the daily range is still relatively tight versus the channel width, which tells you this move has not fully exhausted itself. That combination screams fragile leadership, where rallies get sold fast and confidence is thin. It is a textbook cautious tape, not a crash, but definitely not the kind of action that screams all clear. Zooming out to the DIA, the Dow Jones Industrial Average ETF, and suddenly the story flips on its head. Price just printed a fresh 55-day Donchian breakout and a new 52-week high, showing classic rotation into old economy and defensive heavyweights during the week. So this is where the caution really creeps in, because beneath the surface, the Chaikin money flow is negative, hinting that distribution is happening even as price pushes higher. On top of that, the index is nearly 10% above its 200-day moving average, a historically stretched level that does not leave much room for error. This is not euphoric buying, it is selective hiding, and it perfectly captures a market that keeps grinding up while quietly bracing for turbulence. Turning to the ETNX, the 10-year US Treasury yield, and this is the gravity behind everything we just saw in equities. Yields have been trading above the falling trend channel for 7 straight sessions, sitting almost 3% beyond the upper boundary, with that former ceiling now acting as support. So, this is why rotation made sense last week, because higher long-term yields after the Fed cut quietly tightened financial conditions and pressured growth-heavy areas. The structure is still tight relative to the channel width, which means this move has been persistent rather than explosive. As long as yields stay pinned above that channel, stocks can grind higher, but leadership will stay selective and nerves will stay close to the surface. Switching over to the US dollar index, and this is the quiet lever that can make risk trades feel amazing or awful overnight. The dollar has been sitting inside a falling trend channel for 13 sessions, and it is parked near the middle, about 1.2% below the upper line and about 0.9% above the lower line. Here's what matters. There is slightly more room up than down inside this channel right now, and the upper band has been respected repeatedly, which keeps traders cautious about a sudden dollar bounce. With daily range tight versus the channel width, it suggests any real breakout could require a bigger move than we have seen lately. That is why the market felt twitchy this week, because if the dollar stops falling, it can instantly squeeze the very same growth and risk pockets that already looked fragile. This brings us to the UVIX, the volatility index, and this is where the tension really hides. Volatility has stayed under 20 for 13 straight sessions, painting a picture of a market that looks calm, almost sleepy on the surface. So, this is the uncomfortable part, because this kind of prolonged calm often shows up right when traders start letting their guard down. With stocks breaking trend channels and yields pushing higher, the lack of fear feels more like complacency than confidence. It is that quiet, stretched calm that makes even small shocks feel dangerous if sentiment suddenly flips. And now we are looking directly at BTC USD, Bitcoin priced in US dollars. Bitcoin has been sliding within its trend structure and recently failed to reclaim the upper channel, showing that sellers still have control on rebounds. What really stands out here is volatility, because the Bollinger Bands have been squeezing tightly for several sessions, signaling compressed price action and rising tension. That kind of squeeze often sets the stage for a sharp expansion, and right now the short-term bias remains bearish, with recent closes landing in the lower part of the daily range. This is classic pressure building, where Bitcoin is coiling rather than trending. The takeaway is simple: calm on the surface, but a decisive move is likely brewing once price finally breaks outside those bands. Looking over at GLD, the SPDR Gold Shares ETF, and this quietly tells you where anxiety is being parked. The slope of the 20-day moving average is accelerating higher, signaling that the short-term uptrend is not just intact but gaining momentum. That lines up with the mood from last week, where falling volatility and rising yields still pushed investors to keep a hedge on. Gold was not screaming panic, but it was steadily bid as protection against policy uncertainty and stretched equity positioning. It is another subtle reminder that beneath the calm surface, risk awareness never really left the room. Looking ahead to next week, this is where the real tension could kick in again. Tuesday puts the spotlight straight back on the US labor market, with fresh non-farm payrolls data and the unemployment rate coming in just days after the Fed cut. That combination alone has the power to shake yields and equities fast. Midweek retail sales take center stage, and this one matters because it tells us whether the consumer is still holding up or finally slowing under higher borrowing costs. Weak numbers here would fuel recession talk, strong numbers could push yields even higher. Then Thursday is the big one, inflation data. Both headline and core readings are on deck. And after the Fed decision, markets will be hypersensitive to any upside surprise. Even small deviations could flip sentiment quickly. And to close the week, housing data rounds it out, giving another read on how higher rates are filtering through the real economy. This calendar explains why calm might not last. With volatility still crushed, these releases are exactly the kind of catalyst that can wake the market up fast. Wrapping it all together, this week left us with a market that looks stable but feels anything but relaxed. So, the big takeaway is balance on a razor edge, with rate cuts on one side and rising yields, stretched charts, and crushed volatility on the other. Stocks are not breaking down across the board, yet leadership is narrow and defensive rotation is loud. That means next week is less about chasing upside and more about watching where stress shows up first. Stay alert, because when calm lasts this long, the next move rarely stays quiet. Thanks for watching, take care, and I will see you next week.